Hello, welcome back to the channel. I trust you're having a good time. So real quick, we'll be scanning through the return on assets for the Nigerian Exchange Group. So a brief introduction about the Nigerian Exchange Group, though the name might sound strange, but it's something that you've actually been hearing of over time. The Nigerian Exchange Group was formerly known as the Nigerian Stock Exchange, and it's a company, it's a firm, an organization that has subsidiaries that offer investment related services. So it has different sectors and regulations within itself. So but today we'll be looking at the return on assets for this particular company. So how well do they generate income from their assets? How well do they maximize their assets? So if we look at this chart, we would see that the numbers are represented in percentage. So this result is actually computed. Let's go to the data set for the return on assets. So it's actually a ratio that is computed from the total investments, the total assets, and the total. Let's quickly edit this. Total assets for the company and the net income. So the total assets and the net income is how the return on assets is being generated. So the total asset is how much they have invested in the business and the company for that particular year, and the net income, which is the profit they made after tax, after the investment, the money spent in investment has been accounted for. So this is from year 2018 to year 2023. I think I should put this in clearer picture. Okay, that's quite better. And sure. So okay, yeah, so we can see here, so to get this to get the return on assets, we actually divide both of this metric to get the return on the assets. So the formula is that we'll divide the we'll divide the net income by the total assets, and we multiply by 100. So that's how that was arrived at. So real quick, let's move onto the charts and let's see what it's actually saying. So we could see here that in 2018 the return on assets was 10.9%. Now across many industries, this 10% is actually considered an average. But if we observe the trend, if we fast forward and observe the trend, we'll see that it's somewhat of a downward trend, and this is indicating that the assets are not being so maximized. And Nigerian Exchange Group is a low, it's not a high asset, it's a light asset firm. A light asset firm means that they do not spend so much money on acquiring on buying machineries and all those stuff. Like, well, for example, now an airline now can be considered a high assets firm because they buy big machineries. But companies like software companies, consulting firms are considered light asset firms. So this company is actually a a light asset firm, and we can see that this downward trend over the years is 6 years is showing that this trend over the last 6 years is showing that there's a downward trend in their assets, in the return on assets. So the return on assets is basically saying that, let me give a clearer picture on that. So the return on asset is actually saying that it measures, it's actually a metric that measures how efficiently a company uses its assets to generate profit. So it indicates the profitability of a company relative to its total assets, and it further provides insights on how well the management is using the company's resources. So how well are they maximizing the resources to generate income. So, and one of the importance of this return on assets is that it's actually an efficient, it measures the efficiency, like I mentioned before. So it shows how efficiently a company is using its assets, like I stated, and a higher metric, a higher number here, a higher percentage is indicating better performance, while a lower percentage is indicating a higher performance, like we have here in 2022. Let me draw that a bit closer. So we could see here in 2022 that the return on assets is giving a negative number, which is 0.7%. So that is actually indicating a worse performance for that year. So that year they actually ran a loss on their return on assets. So they didn't really generate anything, rather they ran into loss for that year as regards return on assets. So for a higher one, it indicates a better performance, and for a lower ROA, it indicates a higher metric, like this one we have here in 2018 indicates a better performance, while a lower one indicates a worse performance for that particular year. So I think the highest we have here, according to this chart, was in 2018 at 10.9% here. 10.9%. So this actually said that, okay, in 2018 they maximized their assets in generating cash for the company. So across here we could also see that in 2021 as well. In 2021 they also went up again, in contrast to 2020 where they went down at 4.5%. In 2020 they came up again at 7.6%. So we could see the fluctuation in the trend, that they were not consistent in the in maximizing their return on maximizing their assets to generate the cash. So for this metric, it's actually industry based. It is not safe to compare an industry with another industry. So for the Nigerian Exchange Group, is actually a stock exchange industry, so it is good to compare it with itself, or we compare it across the years, for example for like 2018 to 2019. So with the results that we are having here is from 2018, it appears that they have been dropping. Now what's the importance of this? What's the importance of this return on asset? So it also helps for performance comparison. Like I mentioned before, that when it is high, it means that there's a better performance, and when it's low, it means that there's a bad performance for the company. So this return on assets allows investors and analysts to compare the profitability of companies within the same industry. I stated this, that you have to compare within the same industry regardless of their size. And it also helps to assess the management effectiveness of a company. So it provides insights on how effective the managers are using the company's assets to generate earnings. So for example, you want to make an investment in a company, you want to maybe buy their shares and all that. And I did mention that NGX GROUP Group is actually a company that lists other firms. It's a body that lists other firms where people can invest and buy shares and securities. So like I was saying, so it helps analysts to it provides insight into how effective the managers are using the assets of the company. So if you want to invest in a particular company, you have to look into their return on asset. It's actually a very good place to look and say, okay, how well is this company maximizing the cash, maximizing the asset that they have, the money they have invested here, how well are they maximizing? So it says a lot about the management efficiency of that particular company. So it can actually aid investment decisions. Also, this different companies use return on investment benchmark to check their performance against competitors in the same industry, and it also aids managers in strategic planning, so to identify areas where asset utilization can be improved to enhance their profitability, because the proper management of assets has a lot to do with how profitable the company will be, how much returns they will get. If they manage their assets well, there is opportunities, there are chances that there will be more profit. And if assets are mismanaged, definitely there will be lesser profit, because for example, now their equipment, their machineries are not well maintained and managed and maximized. They can pack up, and then the company will have to incur extra expenses of purchasing new machineries or equipment even before the due date. So these things are very very important, a metric to look at when investing in any organization, to check the ratio, the ROA ratio. It's very vital, and look out for a very high one. And it should also be noted that the higher the ratio is, the riskier it also is. So the odds, the higher it's just like an odd. So the higher it is, the riskier it is, and the lower it is, the safer it also is in investing in that company. So the ROA, return on asset, also has some limitations, which is in the industry difference. Like I talked about before, that the return on assets can vary widely between industry due to difference in asset intensity, making cross-industry comparison less meaningful. So for example, you are comparing, it is not safe to compare a software company to an airline company, because these two are different. The software company is light assets, and the airline company is heavy assets. So it is not safe to compare these two, because if the ROA for the airline company is low, that is fine. But if the ROA of the software company is low, it's not so safe. It means that they have to re-strategize and improve their performance when it comes to maximizing their assets. So also change in asset valuation methods or accounting practice can impact the return on assets. Then also non-financial factors. So the return on asset does not account for qualitative factors such as customer satisfaction, brand strength, or market conditions. So it only takes into consideration financial factors. So there are different ways whereby this metric, this ratio can be improved. So for example, an organization is experiencing a very low ratio like we have. So there are different ways to adopt. For example, now in 2022 here, they were having a very low ratio. So they could adopt measures to improve this. In 2022 also it went down in 2022. So now in 2023 they've still not gone up, but then the trend is taking an upward move. We just hope that it continues like that in 2024 and in the years ahead. So some of the strategies to adopt is to increase the net income. So when the net income is increased, definitely the ROA, the return on assets, will be improved. And so boosting profitability through revenue growth can be a strategy to adopt. We can reduce the cost and can improve the operational efficiency of the company. So when these are attended to, when these are adopted, when this increase of net income is adopted, then obviously the return on assets will go up, and then the company will get back to a good financial state. Then also optimizing asset utilization. So in order to improve the return on assets ratio, so it's also advisable to improve the efficiency of asset use by streamlining operations and enhancing inventory management or upgrading technology. So if some technologies or some equipment are wearing out, instead of trying to manage and repair and all that, once they have used their lifespan, it is better to change them and bring in new ones for effective and efficient operations. And lastly, for that category, so to divest, that is to sell. Yeah, this is also related to the last point I just said. So it is advisable to sell or reduce underperforming or non-essential assets to focus on more productive investments. So when some machineries they are failing in their performance, it's advisable to actually sell them off and purchase new ones. So to cap up the signs that we are seeing here. So we see that out of the 6 years that are measured here, 5 of the years were positive in numbers and 1 was actually negative. So the ones that are positive are actually saying that, oh, this company was doing well. Yes, not actually doing well, but then they still didn't run a loss. It was low, but they didn't run at loss. So we see here that in 2018 this was the highest they had, and the lowest was the worst performance was in 2022 here. So this is actually saying that they performed very badly. This was how I started the video, and I'm concluded in the same way to just do a quick recap. So now 2022 was also positive, but it is very low. This is considered very low. 2020 is also considered low. 2019 is considered low. The ones that are a bit reasonable and showing efficiency in performance is 2018. So 2021 also went up a bit, but that is still not so much acceptable in the industry. So this ROA is actually a very good metric to look at when you want to make investments in a company. So check out how well they're performing. Anything from 10, depending on the company, yes, but then 10 is a benchmark across many countries, although some can be higher, but 10 is actually a very good benchmark to look at. 10 and anything higher is a good signal for how well the company maximizes their assets and to generate income for the company. So that will be all for this video. Thank you so much. I'm excited that you stayed this long with me. Thank you so much. Thank you so much. Thank you so much. I hope that you would be on my next video. Please do subscribe so that you get the notification when I drop it. And please, if you like this video, kindly click the like icon. And if there's anything that you have a different opinion or a point of view, kindly drop it in the comment section. And then until we see you again, bye bye.